Chairman Powell. Good afternoon, Chairman Powell. First off, we'd like to thank you for inviting us to share our perspective on present and future economic challenges and conditions. As always, our objective remains help the Federal Reserve achieve its dual mandate of price stability and maximum sustainable employment. Our agenda is as follows. Number 1, current analysis. Number 2, near-term forecast. Number 3, economic risks. And lastly, number 4, recommendations. Throughout today's presentation, we've incorporated insights from some of the world's leading economists present at this year's annual Economic Policy Symposium in Jackson Hole, Wyoming. Leading names include Stephanie Aronson, Gita Gopinath, and Isabel Schnabel. We've also Good afternoon, Chairman Powell. First off, we would like to thank you for inviting us to share our perspective on present and future economic challenges and conditions. As always, our objective remains help the Federal Reserve achieve its dual mandate of price stability and maximum sustainable employment. Our agenda is as follows. Number 1, current analysis. Number 2, near-term forecast. Number 3, economic risks. And finally, number 4, recommendations. Throughout today's presentation, we've incorporated insights from some of the world's leading economists present at this year's annual Economic Policy Symposium in Jackson Hole, Wyoming. Leading names include Stephanie Aronson, Gita Gopinath, and Isabel Schnabel. We also incorporated relevant economic concepts and models such as the Phillips curve and Madam Vice Chair Bernard's annutation principle into our discussion. We believe inclusion of these cutting-edge ideas and insights enables us to provide a better understanding of where the American economy is and where it's headed. That said, we also pulled data from several government agencies as well as Goldman Sachs. Current economic conditions are sending mixed signals to consumers and investors. As of now, we're concerned that GDP growth will turn negative when inflation remains persistently high. However, unemployment is low and industrial production is solid. Fortunately, consumer confidence is also starting to rebound. The following slides will illustrate these developments using graphs from the Federal Reserve Economic Database. According to the Bureau of Economic Analysis, although the annual growth rate is not in negative territory, real GDP fell from an annual rate of 0.9% in Q2 of 2022, following a 1.6% decrease in Q1. As Chairman Powell already knows, 2 consecutive quarters of negative GDP growth do not little to boost economic morale. As of September 2022, the current inflation rate is approximately 8.3%, which is obviously well above the Federal Reserve's 2% target. This graph illustrates a high degree of inflation volatility throughout 2022. Which suggests that additional quantitative tightening is necessary. According to the Bureau of Labor Statistics, as of August 2022, the current unemployment rate is approximately 3.7%. Although the axes aren't visible here, this graph illustrates labor market flexibility and lends support to our additional quantitative tightening recommendation. Based on the unemployment rate alone, we agree with the Federal Reserve's hawkish economic outlook. Industrial production, which measures gross output of businesses in the industrial sector, notably manufacturing, grew 3.7% year over year as of August 2022. Although the axes aren't visible here, this graph illustrates industrial production flexibility and provides additional support for our theory of rebounding consumer confidence. In September, consumer confidence officially rebounded from its June low, which indicates that a strong job market and falling gas prices are contributing to an increasingly optimistic economic outlook. The June low is visible here. Consumer confidence fell to a bleak 98.7 before increasing for 2 consecutive months to 103.6 in August and 108 in September.
To put current trends in perspective, participants in the global economy have been extremely fortunate that globalization has enabled economic growth and stability since the Great Moderation. On the domestic front, globalization has produced lower commodity prices while simultaneously strengthening developed and emerging economies. Likewise, globalization puts downward pressure on products costs while simultaneously increasing the supply of workers and subsequently increasing productivity. Unfortunately, globalization is currently under threat due to the ongoing Ukraine crisis, which we will discuss later and in greater detail through the lens of the Goldbanath and Schneibel presentation. In 1991, the fall of the Soviet Union contributed to a surge in the labor force participation rate. However, recently, this metric has begun to trend south, largely because participants are retiring earlier and living longer. Transition to the present, the United States has realized 2 consecutive quarters of negative GDP growth. And while the National Bureau of Economic Research has not officially declared a recession, current trends most definitely indicate an economic contraction. On the industrial front, while production growth remains positive, the trend has started to slow, and we expect this to continue as the Fed raises interest rates. Capacity utilization also remains strong. However, this too has started to slow, and we expect capacity utilization to decline almost proportionally to GDP growth as pandemic-induced aggregate demand begins to burn off. In the consumer-centric American economy, falling consumer confidence is one of the leading indicators of a recession. Earlier this year, consumer confidence started to slip. However, recently, it has begun to rebound, which we suspect is at least partially explained by falling gas prices. Stock market volatility is also one of the leading indicators of a recession. Last week, the stock market revisited its yearly lows, with the S&P 500 index falling below 20% for the second time. While most Americans don't have single stock exposure, the end of the tech rally, combined with rising interest rates, has renewed recession concerns. The combination of low interest rates and remote work contributed to 2021's hot housing market. As the Federal Reserve continues its aggressive rate hike campaign, housing affordability is at record lows, and we suspect the multiplier effect will slow broader economic activity. Traditionally, a slump in the number of Americans buying homes coupled with falling home prices indicates a recession. However, this slump is coupled with rising home prices, which lends support to our theory of mixed signals. All signs point to a seller's market, but the sellers aren't selling, which will further perpetuate the current cool down.
Our near-term economic forecast is relatively consistent with the Federal Reserve's. However, there are some marked differences with ours. We are more optimistic about the GDP growth rate and anticipate this metric to total approximately 0.5 to 0.75%. We anticipate that the unemployment rate to increase from 3.5% to approximately 4.75%, which is also consistent with the established trade-off between inflation and unemployment. With that being said, we anticipate that inflation will not reach a 2% target rate, despite aggressive interest rate hikes. As of now, we believe it is more realistic to anticipate inflation rates of 4.5% to 5%. Stock market volatility will persist and will likely result in falling consumer confidence. In her speech, Reassessing Economic Constraints, Maximum Employment or Maximum Hours, Brookings Institution Vice President and Director of Economic Studies Stephanie Aronson noted that average work week has declined from 40 hours to 38 hours currently, which suggests excess workforce availability and unrealized productivity. In theory, employers could squeeze more hours out of a current full-time employee. However, we anticipate that labor market trends like the Great Resignation and quiet quitting will prevent this from happening. Aronson's phenomenon was also evidenced by Goldman Sachs job workers gap, defined as employment plus job openings minus the labor force. This fell by 700,000 in July. Average hourly earnings are also on the decline, which is consistent with the idea that the supply-demand balance in the labor market is starting to improve.
The previous slide suggests that the American economy is experiencing some relief on employment-led wage growth. Additionally, according to Goldman, we are also experiencing sharply lower commodity prices, a strong dollar, and gradual improvements in supply chain disruptions, all of which suggest that goods price inflation will continue to abate. Conversely, services price inflation will continue to persist because pandemic-induced demand is not being satisfied because of a worker shortage. As of now, major investment banks are pulling out of the housing market. In the housing downturn further to fall, Goldman Sachs analysts published predictions of steep declines in new home sales, existing home sales, and housing GDP, 22%, 17%, and 8.9% respectively. In her presentation, How Will the Pandemic and the War Shape Future Monetary Policy?, International Monetary Fund First Deputy Managing Director Geeta Gopinath alleged that existing economic models like a flat Phillips curve cannot explain the inflation surge, and instead identified massive global stimulus and goods-biased spending as contributing factors. Likewise, Gopinath noted that the Great Resignation destabilized post-pandemic labor supply, and the outlook remains uncertain despite a narrowing jobs workers gap. Gopinath also noted that climate change is a contributing factor to the inflation surge, which is consistent with Isabel Schnabel's assessment. The inverse relationship between globalization and the economic effects of climate change is currently under threat. Schnabel argues that the green energy transition will be to the modern global economy's detriment because the Russian invasion limits fossil fuel supply at a time when renewable energy carriers are not equipped to meet demand. Based on the laws of supply and demand, we know that competition for scarce resources puts upwards pressure on commodity prices. Additionally, Schnabel argues that fiscal policymakers need to prioritize green investments, whereas monetary policymakers need to protect price stability. She alludes to the inevitable trade-off between inflation and unemployment, and ultimately suggests that a moderate rise in inflation. While we agree with her latter points, we disagree with Schnabel's green energy focus. An improperly timed green energy transition will only serve to further destabilize fuel supply and global energy security. Chairman Powell, our recommendation is relatively similar to the Federal Reserve's current course of action. The Fed should continue its aggressive rate hike campaign and apply quantitative tightening strategies. That said, we anticipate the cost of mortgages, auto loans, and personal loans will continue to rise, as will corporate and municipal bond yields. Conversely, we anticipate that capital investment in the private and public sectors will continue to fall, and as a result, we anticipate layoffs, higher job openings, and lower disposable income, all of which will hopefully return inflation to the 2% target rate. Thank you again, and our team is available to answer any questions you may have.